In this video we are going to talk about how banks enslave you. So before starting this video, please like this video and subscribe to our channel for future updates. If you don't understand money, it can imprison you. If you let it, money has the potential to set you free and provide you with options. They are the folks who people like and trust. Many people, in particular, would describe Apple as a brand they love. What banks fear the most is that GAFA will eventually own the customer relationship and that they will be reduced to just white labels at the tail end of the process. Please allow me to elaborate. Why not get a loan through Facebook if you trust the platform? Because Facebook is not a bank, it will auction your loan to a pool of banking partners and then choose the best offer for you. You don't care if the loan is from JP Morgan, Santander, or any other bank. What you're looking for is a painless way to get your loan at the best terms possible. In this scenario, banks do not control the client relationship and compete only on price, putting severe pressure on their profit margins. It's similar to when a corporation sells white label products to supermarkets like Carrefour and Tesco. There are few strategies to develop highly lucrative firms in most industries. You may have a technological or know-how advantage, a monopolistic or oligopolistic position, which, by definition, cannot endure indefinitely, or you may be protected by regulations that create a barrier to entry. Banks have historically held an oligopolistic position in most countries, which has been preserved by law. Fintech regulations are now more favorable, and bank oligopolies are no longer viable. The current financial system, in which money is largely, i.e. 97%, debt money, makes us all indentured slaves. The more fresh credit the major banks can give in exchange for our pledges to repay, the more interest they can earn, but the harder it is for us to service that debt. Rising housing prices mean that the banks can produce more money out of thin air, and the population becomes more enslaved as it struggles to pay the bank's mortgage, the landlord's rent, or a mortgage, obtained from the bank, or face eviction. This system has enslaved us. This, however, does not have to be the case. The concept of money is a social construct. We have the power to transform money in the world. The growing inequality within society between rentiers and those who work for a living, the increasing vulnerability of the real economy to financial booms and busts, and the channeling of investment away from real wealth production into financial trivia will all be alleviated if we rebase the system on sovereign money rather than debt money. The vast majority of society will benefit, and the banking elite will be reduced in size. Changing the way money is created is one approach to accomplish this. The vast majority of money in circulation in the economy is digital information maintained in, or moved between, bank accounts held by businesses and people. When these banks issue you credit, they simply produce digital money out of thin air, or, to be more precise, double-entry bookkeeping. After that, they charge you interest. If you think a loan was only available because of someone else's deposit, you're just delusional. It's a common illusion, and it's a very plausible one, but it's still an illusion. Consider this. It is natural to assume that if a company offers to rent you a car or if a neighbor offers to lend you his lawnmower, they actually own the car or lawnmower. This supports the idea that money lent by one person equals money deposited by another. However, thinking in this manner is erroneous. And the banks have no intention of deceiving you. But the fact is that practically all money is created when banks open credit lines. It's almost entirely dependent on debt. When you spend this digital money, the banks have effectively created their own currency by replacing their name for yours on the check, bank transfer, or other financial instrument. The solid reputation and proven reliability of promises from Barclays or HSBC replace the up-to-date trustworthiness of your own promises to honor the countless transactions of daily trade. The only thing stopping the banks from flooding the economy with this digital money is the risk of running out of creditworthy borrowers, dependable debt slaves, by exchanging their own credibility for your commitment to repay. If you spend the digital credit granted by the bank and then fail to repay it, you are actually out of pocket. Furthermore, the concept of personal creditworthiness is largely subjective and influenced by overall economic optimism. Credit can be plentiful or scarce, like hen's teeth. Of course, under this system, the banks not only generate money out of thin air and then rent it to you. When you repay the line of credit on time, the money simply vanishes. The quantity of money flowing in the economy is determined by bankers' attitudes as they trade off between greed and risk aversion in this system of money production. If the rate of debt repayments exceeds the rate of money production, the total amount of money in the economy shrinks. Yes, the system we have currently destroys money as well. A sound money system, on the other hand, would not be vulnerable to such whims. As a result, the total amount of money circulating in the economy is today determined by bank confidence. They will ease loan requirements if they believe the times are good, and they will especially appreciate it if company confidence is high, employment is expanding, spending is high, and asset prices are soaring. Specifically, rising housing values are attractive to bankers as collateral for their loans. When people lose faith in the economy, money circulates less because loans are repaid, or defaulted, and not replaced with comparable new loans because credit conditions are tightened. The collapse of the predominantly American subprime housing market was the catalyst for the worldwide banking crisis of 2007-08. When the value of the assets used to secure loans begins to decline, the temptation is to sell them, causing prices to plummet even more. Governments, i.e. you and me, the taxpayers, must intervene to prevent the entire system from collapsing. Individual banks have been saved or allowed to fail, but the greater issue of lost confidence and the collapsing money supply is more difficult to fix. As a result, all throughout the world, quantitative easing, QE, is being used. QE is when a central bank, such as the Bank of Japan, the Federal Reserve, the European Central Bank, or the Bank of England, intervenes to increase the supply of money in order to compensate for the decrease in aggregate money generated by private banks. To fill the void left by receding private money, central banks generate new digital money. It should be mentioned that the current system of quantitative easing operates by inflating the value of existing assets by increasing the reserves of banks and other financial institutions. In reality, the Bank of England calculates that the previous round of QE, which totaled £375 billion in 2009-11, enhanced the wealth of the richest 5% of all families by nearly £128,000 each, while achieving absolutely nothing for the bottom 50%. However, if the goal is simply to avoid deflation, it would be just as possible and certainly more reflationary of economic activity, rather than share prices and property values, to give newly created central bank digital money to households to spend in the real economy, or to use it to finance public projects such as house building, infrastructure, or alternative energy, i.e. as a result, the current monetary system, which is centered on private banks allocating credit, is insecure and unfair, and is causing the UK economy to become overburdened with debt and property prices that are out of control. It reduces the vast majority of the population to debt slavery while favoring a select minority. If we want to alter course, we need to change the way money is created. The 1844 Bank Act was enacted to prevent the production of private money by requiring all cash, including coin and paper, to be issued by the Bank of England. Money would be sovereign, and seigniorage, the difference between the cost of making coins or paper money and the face value, would go to the government. Checks, credit and debit cards, and more sophisticated loan instruments have proliferated, and the importance of private debt-based digital money now considerably outweighs cash, thanks to computerization and deregulation. Nonetheless, the majority of people, including a sizable number of MPs, continue to believe that money is created only by the government. To break out of the existing broken system, we need to restore the purposes of the 1844 Act and construct a new act that encompasses coin, paper, and digital money that is suited for the 21st century. Make the people the masters of a new sovereign money that is debt-free. Change the money, and the world will change. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.